and welcome to the panel on private debt, mezzanine, and distressed investing. I'm very happy to be here as the president of Croatian Private Equity and Venture Capital Association, supporting the SC Private Equity and M&A Forum already since 2012. And I'm also very honored that I have here with me distinguished speakers covering both private debt and mezzanine investing. So I have here with me Chris Buckle, who is a co-managing partner at Mezzanine Management, and Emmanuel Dahl, who is investment director at CVI Dom Malerski. Perhaps I will give an opportunity to my speakers to very briefly introduce themselves. Chris, can you please introduce yourself and your fund?
Sure. I'm co-managing partner of Mezzanine Management. We've been a fund advisory business in this region for 20 years now. In that time, we've raised and invested 4 funds, so over 800 million euros. The latest fund, Accession Mezzanine Capital 4, was 264 million, raised in late 2018. We've made 9 investments from that so far. And overall, we've made 54 investments in that period in 12 countries of Central and Eastern Europe.
Okay, perfect. Emmanuel?
Yeah. Good morning, everybody. Yes, so I'm investment director with CVI, which I joined 2 years ago. Prior to CVI, I worked in London and Paris in areas such as private debt and financial restructuring advisory. CVI is a leading private debt investor in CEE with about €1 billion of assets under management. We offer a whole range of products from senior debt to unitranche, distressed capital as well, and mezzanine obviously as well. We do invest between 2 and 20 million euros per transactions in countries from the Baltic to the Balkans. In terms of industry, to be extremely short, we are fairly agnostic. We have significant exposures to industries such as manufacturing, financial services, consumer goods, trade and services. And we have a significant exposure in real estate as well, where we help finance development of new assets such as residential units, logistics centers, offices. And I will finish on this. I'm quite glad to say that we have recently set up a new real estate fund with other Polish asset manager.
Excellent. And now, before we go in the main discussion, just for the benefit of our audience, there can be some confusion of the term. What does private debt mean? What does mezzanine mean? And what are the distressed investing as a definition of an investment strategy? So, if I can just ask perhaps Chris to define mezzanine, and maybe Emmanuel to define private debt, and then maybe you can both tackle a little bit on distressed investment, not when it happens in your portfolio, but as a specific investment strategy, very briefly from a practical, not academic point of view.
Okay, I'll deal with mezzanine then, since it's in our name. I mean, traditionally, mezzanine is subordinated debt. So it ranks behind senior debt, senior bank financing, but ahead of the equity. And it's traditionally been used in private equity-led leverage buyouts, basically to increase the total leverage in the transaction, because mezzanine is cheaper than equity. So it's more of a replacement for equity than a replacement for senior debt. By increasing the leverage in a transaction, it reduces the average cost of capital. It allows private equity funds to do larger transactions, and it allows them to leverage up their own returns. So, and traditionally, mezzanine has been a non-amortizing bullet loan of 6 to 8 years, normally with a yield and some kind of equity kicker, although some players would just have a high yield. So that's traditionally what mezzanine is. And indeed, we started out doing that as well. But over time, our funds in particular, we've gone a little bit towards the more development capital end of the mezzanine spectrum. So we consider ourselves now more like a growth capital fund. So about 75% of the transactions we do now are not buyouts, but they're sometimes of some kind of development capital, either to private equity-backed companies or to privately owned companies. So either for stepped growth, big capex projects, add-on acquisitions, moving into foreign markets. And in these situations where we're rather solving problems rather than taking the risk of higher leverage. So we solve structural problems, other risks like going into asset-light businesses. So we see ourselves as more of this growth capital solutions provider. And indeed, we can even invest up to 30% of our fund in straight equity, but only alongside the loans. So we're not a private equity fund. We don't own companies. We finance them. We back good companies. We back good management. And we still do some traditional mezzanine deals as well.
Lovely. Great for the very detailed explanation. And maybe I would like to give a floor to Emmanuel to explain a little bit what private debt is all about.
I think it's important to actually recall what private debt is about, because quite often we actually see companies or advisors even coming to us saying, we do need mezzanine for this transaction. And it turns out that their definition of mezzanine is actually debt which is coming from a partner which is not a bank, right? But actually, we are here referring about private debt. Private debt is actually debt, which is provided by, let's call them alternative investors, such as mezzanine management or CVI, for instance, in the CEE region. When it comes to the definition of senior debt specifically, that's quite the contrary of what Chris described, which is debt which does benefit from a first lien pledge against assets of the company. It can be a first lien pledge against manufacturing installations, but it can be as well a first lien pledge against shares of the borrower, for instance. So senior debt is basically debt which is ranking first, potentially before subordinated lenders, such as mezzanine lenders. But then the senior debt itself, just to go one step further, can actually be, I would say, broken down in different subcategories, such as senior debt, more classically unitranche as well, which is a word we do see when we come across quite and especially in the CEE region. I would say, just to give one number, that senior debt is debt that, as said, has a first lien pledge, but which does have a quantum of about 3 to maybe 4 times EBITDA. Unitranche has a quantum of, but let's say, between 4 and 6 times EBITDA. And the definition of unitranche is, so it's the combination of some sort of senior debt plus a junior tranche as well, but not to overcomplicate. That's what I would say at this stage.
Okay. Can I just comment on the kind of the credit fund strategy as well, because we agree very much with Emmanuel that this is an interesting sector, and it's very discrete from mezzanine and growth capital. For that reason, we've also been looking whether we can help develop a product in this space. So we've actually teamed up with a very experienced team of credit professionals to also raise a credit fund, very similar in nature to what Emmanuel was mentioning. So this is a fund that will be focusing on the mid-market, lower mid-market. So that's companies with revenues of over 20 million, EBITDA 4 million and above. And this is a space that's not that well provided for by traditional lenders. So we're also looking to help this group raise a fund. It will be doing senior debts, second lien, unitranche, the same as Emmanuel mentioned, maybe a little bit larger than CVI. So the target would be 15 to 20, up to 40 million euros per transaction, because this will be a 400 to 500 million euro fund. And again, we believe there's a lot of room in the market left by the banks, etc., to raise such a strategy in the region.
No, it is a very sensible strategy. I absolutely agree with you. And that actually swiftly brings us to our next topic. And as you are both the private debt and the mezzanine fund managers, I would like to ask you, how are you responding to this big reset since COVID-19? This is a time of change and opportunity, obviously. So which activities have you been mostly focusing on since COVID-19 crisis in March 2020? Is it the portfolio management and consolidation? Is it the fundraising for this new fund that you have just mentioned? Can you actually do any exit in this current environment? Or do you look for new opportunities that arise? So Emmanuel, would you like to tackle this question first? Emmanuel?
Yes, sorry, got interrupted. Yes, it's true that in March, actually, everything changed quite a bit. When it comes to fundraising activities, it got actually halted to some extent at CVI for the simple reason that LPs themselves interrupted their new commitment activity as well. So LPs being institutional investors such as insurance companies, pension funds, who could be investors in funds such as the ones being raised by CVI and mezzanine management. So, the fundraising activity has been halted to quite a large extent for many reasons, because LPs themselves focusing on their existing portfolio. So trying to understand what is the impact of, potentially impact of COVID on their existing exposures to different funds across Europe or more globally in different strategies. So, I mean, this was quite a change for us. But the same goes for CVI, because we had actually to spend much more time supporting our portfolio companies to first try to understand what could be the impact on the operational level of the portfolio companies first, then to support, as an extension, what could be the impact on the liquidity profile of those companies. And this is really the most crucial part of what we have done in spring, because you just want to avoid the situation where a company lacks of liquidity to fund its operations. You want a company to be able to pay its suppliers more or less in time to continue operate to the best extent possible. It's true that we had, on very rare occasions only, situations where we needed to actually, waive interest payments or even, amortization payments. And this actually is a testimony of the quality of the portfolio we had. So that's quite a good thing we are proud of. We have 120 portfolio companies, more or less. So it's obviously a lot of work for us in terms of monitoring, but we have a large team as well to do this and to support these companies. And this is what kept us busy, for the most of the time. But we had the time as well to continue to develop the pipeline of new transactions. But I suppose that's actually the topic of the next question.
Yeah, no, absolutely. So, Chris, if you want to tackle this question, can you just, for the benefit of our audience, maybe say percentage time split spent in portfolio management and consolidation, looking for new investment opportunities, fundraising, or doing the exit? If you have to divide 100% of your time, how would you do the split since March 2020? What has been taking the most of your time?
Sorry, you cut out a bit. Was that a question to me?
Yes, it was a question to you. So I'm just asking you, if you go back to March 2020, since then, in the past sort of 8 months, can you divide your time and provide an approximate percentage split between portfolio management and consolidation, looking for new investment opportunities, fundraising for this new fund that you have just mentioned, and exit? So what has been taking the most of your time?
Okay, well, I guess like everybody else, when the first wave of COVID-19 hit in March, we spent a lot of time just looking very carefully at our portfolio. Dealing with our managers, basically.
I think we are losing you, Chris. Hello? I think we don't have you anymore. Hello? Emmanuel, can you hear Chris?
No, I cannot hear him and see him, but I do see you and hear you quite well.
Okay, so, let's just, maybe, Chris, if you can refresh your browser. Yeah, I do apologize to our audience for all of these technical issues. We'll wait for Chris to solve the technical issues and joining. And I would like to move to our next theme, and that is, the change landscape and the market sentiment and the level of activities. So where are the private debt markets today? So where is the current focus? Where do you see this opportunity at the moment? Or so which sectors are a little bit more resilient to the crisis?
Sure. I think what is taking place in the CE region is to some extent no different to what we see in other markets such as Western Europe. And I would like to go back 10 years ago when the global financial crisis broke out in 2008 and 2009, and to just remind that this was exactly the point in time when, at least in Western Europe and in North America, when private debt actually got a much larger market share in the debt markets, and this was due to the fact that you might recall that the banks were actually in a fairly weak position and actually were quite constrained when it came to making loans to actually the opportunity for private debt investors who were obviously loaded with dry powder to actually make transactions and to actually gain capital market shares from the banks. I do have the conviction that in CEE, where at the time being private debt is still a fairly low penetration rate in the total credit markets, I do have the feeling, and there are signs already which say that the market share of private debt in CE will increase as well. The banks already in the region have, become a bit more, have more constraints in the current market to lend to their companies. And this is the reason why that we do see actually an opportunity for private debt investors to expand their playground in the region. So I'm quite optimistic. That's one point. The second point I would like to make at this stage is that, of course, the current climate raises a lot of uncertainties about potential performance of companies, and therefore there is a bit of, more, I would say, uncertainty when it comes to understand what is really the risk profile of the transactions. Just to take one example, we are now in October, but still it is quite difficult for us in some cases to understand what could be the full year performance of companies. So if you have this type of difficulties, you might just assess that the risk profile of transaction is higher, and you might expect slightly higher returns than what you would have expected for similar companies before the outbreak of COVID.
Lovely, thank you so very much. And now I'll just want to give an opportunity to Chris to just briefly comment first on, what has been taking your time since March 2020. Is it looking for is it portfolio management and consolidation, new opportunities, fundraising, realizing exits, and then we move to the topic of how do you see the market sentiment actually in the moment that has probably influenced the time spent in pursuing your management of the fund activity.
Okay. Well, actually, 2020 has been an excellent year for us, surprisingly. So the portfolio was held up very well, and I think that's a reflection of the fact that we invest in
Emmanuel, do you
businesses.
hear him or?
I hear him, yes, and see him, yes.
Okay. We invest
I don't.
Okay. Well, we invest
you
in
can hear Chris?
Non-cyclical. I do, yeah.
Right. We invest in non-cyclical, mature businesses, and these are very kind of modern, well-run businesses. So these are professional operations that, they use all the modern software tools. Often they're actually asset-light businesses. So they've been very well able to respond to this pandemic and continue operating. Many of them are actually doing better, actually. So yes, we looked at the portfolio. It's actually been an excellent year for exits as well, because actually there's a very strong M&A market out there for well-positioned businesses with good long-term potential. So we've actually exited 8 transactions in the last 12 months. Two in the height of the pandemic and the lockdown. It was a little more difficult to get them done. Things went more slowly, but the valuations didn't change. The appetite was still there and continues to be there for very good businesses. And these were not fire sales. These were good exits driven by the continuing good performance of those companies. Make new investments as well. So we completed one in April. We have another one in documentation right now. So actually, it's kind of business as usual. The fundraising, on the one hand, the fundraising for this new private debt fund, it's going a little more slowly, but actually the demand is out there. We're still in a very low interest rate environment, so investors are looking for yield, and also they're looking at kind of lower risk assets because of the perceived uncertainty out there. So a senior debt focused credit fund fits that criteria very well. Shall I say a little bit about outlook?
No. I just want to ask you a question. Specific. Maybe you can mention the name of the exits you have realized, and maybe the sectors that you have been investing in. So just for us to have a little bit of feel what has been happening on your side.
Yeah, I mean, we try and avoid cyclical businesses. We've always invested quite a lot in the service sector and kind of asset-light businesses, where I think we have a natural advantage. Banks still like a lot of asset security. We look very much at the business and the cash flows. So the 3 exits we've had most recently, we exited actually pre-COVID, but at the end of 2019, we exited Net Risk, which is an online insurance broker in Hungary, where we teamed up with them. MCI, and we from Optimum in your home country, Myrna. Optima Pharm is a clinical research organization, so it runs clinical trials. For us, this was a typical growth transaction. We invested in the company in 2018 for organic growth, add-on acquisitions, positioned it, grew sales and EBITDA by more than doubled them. And then in May, we exited to a regional private equity fund, which will then take it on for further growth. And the most recent exit is ATM in Poland, which is a data center business, the leading data center in Poland. And actually, this is a sector that's doing extremely well, generally, and increasingly so because of the pandemic. Everyone's using computers more. There's a lot of data flying around. So we got a very good exit on that just in the last month. So and the valuations didn't come down. They were a little slower to complete, but valuations held up very well. And new transaction we completed in July in the packaging sector. So
that's all an excellent and positive news. And maybe now I can ask Emmanuel from his perspective, which sectors did pass the COVID-19 reset endurance test? And maybe if you want to comment from your specific activity, referring to the sectors or whatever you see in the market from the private debt side.
Sure. We have seen maybe less opportunities this year compared to I would say more normative years. But nevertheless, there were quite a few opportunities coming to us, and I would just try to put them in different categories to try to explain the type of needs that SMEs, because we are mainly addressing SMEs in the region, what are the needs that these SMEs had since the outbreak of COVID. I would say that you had those companies which were in urgent need of fresh money to support their activity. So of course here you are potentially more, but not necessarily, in the situation where the company is stressed or distressed. Then you had companies who needed capital to finance the development of a new asset, to fund a new project. And these are typically issuers which are fairly resilient and which believe that the current situation will most likely have little effect on their activity level. So these are players which are fairly confident that they can take on more debt because their activity is strong enough to be able to serve this debt. And then you had companies as well who needed capital to close M&A transactions. And we said already in this panel and in previous panels that M&A activity is fairly strong. There are new opportunities there to be taken, and this needs to be financed by equity, by traditional bank debt, or by anything in between, which can be mezzanine or even more generally speaking private debt. I would say that of course those industries which have fared quite well since the outbreak of COVID are more defensive industries, such as healthcare, to some extent manufacturing industries, companies as well. And this is justified by the fact that the manufacturing has been brought from offshore to onshore in different sectors. And Poland, for instance, and Romania have benefited from this trend by relocating to Europe, manufacturing of different type of consumer goods or industrial goods as well. Of course, there are industries which suffered quite a bit. We've seen them in the news, so no much need to actually go too much into detail. But retail, of course, has suffered quite a lot, and in particular anything which is related to apparel, for instance. So these are, of course, those sectors which suffered quite a bit since the outbreak.
I'm unable to hear you, Mena.
Same for me.
Sorry, I apologize. My mic was muted. So, Chris, you were just referring to your specific deals that you have done and you have looked at and you have invested. But I'm certain that you see the deal flow in the entire market, and maybe you can a little bit comment on the opportunities at the moment. How has current crisis altered, the sectoral opportunities? Where do you see the movement? And maybe, your answer doesn't have to be just one-sided, because as we have been moving through the crisis, we see the first cohort of deals since March 2020, and then the second cohort of deals, and now I would say that we already moved to the third cohort of deals as we are entering the second wave of pandemic.
Yeah, I mean, not surprisingly, we are seeing quite a lot of introductions from companies that have suffered due to COVID-19, which is quite sad. But we don't do rescue financing. We're not turnaround specialists. And probably these companies are in sectors that we wouldn't really focus on anyway. What we're focusing on continuing to focus on are leaders in non-cyclical sectors, businesses where we see sustainable competitive advantages regardless the cycles. We were expecting some kind of economic downturn anyway, so we didn't know that it would be triggered by a pandemic, but these cycles happen, what they're triggered by, and therefore we're always looking for businesses that can ride out those cycles and also are well positioned for some of the other trends in the market. Movement towards e-commerce, digitalization. These are trends that are maybe being highlighted by COVID-19, but these were trends that were going on anyway. Asset-light businesses. As I mentioned before, we can look at businesses that have very little fixed assets. We're not hung up on security. We're looking at cash flows and sustainability of a business model. So generally, we don't see a big problem on deal flow. We see less competition. The banks have their own issues. They have huge portfolios and they will have problems in there. Banks also tend to be a little bit bureaucratic, and the COVID-19 probably has quite an effect on how they operate, and we've seen them really slowing down in any decision making. And also for capital outside region, it's a bit difficult to do a deal in Central and Eastern Europe now if you can't travel. We have a significant advantage in that we have 5 offices over the region. We've always believed in having local knowledge and local expertise. And actually in this pandemic, it's also useful because we can still travel within those countries and go and visit the companies, because it would be difficult to do a transaction purely virtual. I'm not sure we could do that, but we can still visit. So generally, pretty optimistic. We can't hear you again, Mena.
Yes, you touched upon a very important issue, and this is practical implications on deal making or portfolio management or exits in the current environment. So how do you actually deal with the current COVID-19 restrictions, and how do you organize all the logistics in this fragmented frontier and emerging markets of Southeast Europe? Can you easily replace physical meetings with the virtual? Maybe I'll ask Emmanuel first.
I would say you can never replace really, physical contacts. But the truth is that one needs to actually, progress in due diligence processes to try to advance, as much the transactions as you can, and you have no choice. You have to do it, through the computer, unfortunately. But I would say that's only one part of the process. when it comes to dealing with SMEs, which is our market in CEE, we are here talking about companies which are of to some extent limited size, which have a management team which is fairly narrow, and which are managers which are heavily involved in daily operations of the company. So I would say that now in this COVID situation, it is to some extent no different to pre-COVID situation and hopefully post-COVID situation, which is that to close a transaction for a private debt investor such as CVI, where the issuer is an SME, you need strong commitment from the potential borrower to the process, right? Because without commitment, the processes are dragged for quarters and quarters, and this just does not lead anywhere for in most cases. So that's one thing. The second thing is you need quality of information to be able to assess the risk profile of a transaction. And again, to some extent, this is no different to pre-COVID, because as always, the devil is in the details, and you need to really understand, what the performance of the company is, what it is, where are the changes coming from, and in this, 2020 year, it is quite, as I said already before, it is quite difficult to understand what the landing can be by year end for most companies. And again, it is a question about the information quality, because without details, it is difficult to understand really the risk profile of a transaction, and it is difficult to build trust and confidence that this is a transaction you want to make, as long as you have not enough information, right? So in this context, providing quality information is possible, right? And I think that people have got used to using technologies to share information in different shapes and forms, and I think that this works quite well. But of course, it's true that, as it was said already in previous panels, you need to be on site as well, especially for those companies which have physical assets which are critical to their daily operations. And it's true that doing this remotely can work to some extent, and people have been quite creative there. Sometimes doing videos to actually show what the premises look like, and so on and so forth. But it's not easy to actually do business with companies you do not know, with managers you have not met yet. But there, and that's actually quite a strength of CVI, we have quite a lot of repeat business with issuers who we know already, who are potentially currently in the portfolio or who have been in the past. And it's true that this trust is already there, in most cases. And in those cases, it is more easy to consider closing a transaction remotely without having met during this very specific process.
We can't hear you, man.
We cannot hear you, Bernard.
Sorry, I would like to ask you, Chris, the same question. So you already touched upon on the practical implications of doing deals in the post-COVID-19 environment. So can you actually close a deal and what are the impediments on thinking primarily on traveling and COVID-19 restrictions,
Okay.
if there are any, or can you manage in the current environment?
Okay, well, we can close deals, and we have. So that answers that one. It's a little more difficult. We've always been believers in very deep due diligence, understanding businesses very well. So we've always looked at contingency plans and things. Now we also have to look at contingency plans for COVID-19, how that might affect forecasts. But that's similar to our normal processes. Obviously, I think it would be irresponsible to travel and have lots of meetings where you can replace it with video conferences these days. So we are trying to do as much as possible online, but really any transaction we do need to meet the management and have a look at the facilities at some point in the process, probably a little less than we did before. But as I mentioned before, we have 5 offices across the region. staff with local people, so that makes that a lot easier. So we are still able to do that. So and we complete 3 or 4 transactions a year. So you know, I think if we were trying to do 20, 30 deals a year and we had a huge hierarchy in our organization, it would be tricky. But we have a very lean, mean organization. Decision making is still very quick. So I don't think it's going to massively affect our business model. He says, coffee.
That's excellent news. And let's move to a very important deal-making ingredient, and that is how do you actually structure the deal? Has that changed since the March 2020? How available is perhaps senior debt? Are the banks willing to participate in the deals? And you know, what type of investors are interested to what type of structures? Because you are almost never alone in a transaction. You have a sponsor, the private equity investor, or a strategic, and then you might have somebody else on board. So and you know, obviously the private debt comes instead of or together with the senior debt provider. So can you maybe comment how has the structuring been impacted by COVID-19 crisis? Emmanuel?
Sure. Yes. I think it all depends, you know, where you are in the market. Again, I think it was said on the previous panel that, you know, if you are looking at mid-market, you know, companies which are in defensive industries, it is not so difficult to actually get leverage. CVI's reality is slightly different in that, you know, the typical target is an SME company which has, you know, EBITDA between, you know, in most cases, between 2 and, you know, 15 million euros. So we are here really in the small to mid-market, you know, level. And so that's one thing. So these are companies which are potentially, but not necessarily, potentially, you know, more subject to changes in performance than, you know, companies in the same industry but which are larger. So these are companies which potentially attract less interest from the banks. So that's one thing. The second thing is that, you know, CVI's reality again is that we do lend to essentially companies which are not owned by a sponsor. And this is related to the fact that private equity penetration in the region is fairly limited as well, especially in the small to mid-market area. So I think that you know, it is a bit more difficult for companies to get access to bank financing for the reasons we mentioned before, and this is exactly the reason why private debt is potentially of interest to any structure that needs to be set up in current circumstances. And the reason is that private debt, by definition, is an instrument which is elastic, right? Much more elastic than, you know, in most cases, than what banks can offer. Private debt is elastic when it comes to the way we set up maturities, the way we schedule amortization, the way we oblige interest payments to be made. We are potentially more flexible when it comes to the nature of the collateral that we do benefit from. So I think that, you know, it is not difficult for, I would say, any viable company in this context to raise capital from a private investor.
Thank you. And what about you, Chris? On the structuring side, you have been closing deals, which is impressive indeed. So has the structuring changed now compared to previous years?
It's quite a difficult question to answer. First of all, you would imagine some downward pressure on overall valuations of companies. We haven't seen that in the really well-positioned good companies we've seen. If anything, maybe there's a supply and demand issue for really good companies and valuations are even going up. In terms of structure, we always structure transactions. There's no set structure. we very much create a bespoke solution for the demands of a transaction. So it's difficult to say whether it's really changing. We are seeing banks, maybe their appetite hasn't changed, but having some difficulty to deliver. And therefore, we are seeing situations where the structure and the pricing of the transaction is not the key consideration. It's can you deliver? And, you know, we have a small, flexible team, capital available. So some people are coming to us and saying, right, we'd like to take money from you because you can deliver. And the structure is not such an issue. It's, okay, yeah, you're pricing your structure, that gets the deal done, and therefore that's the key consideration.
We cannot hear you.
Sorry about that. So we are unfortunately reaching the time limit. I didn't see any questions from the audience. If there is a question from the audience, you have 1 minute to put it by putting it in a chat box, if you will. Before we move towards the wrapping up and concluding remarks, I just want to ask Emmanuel to just briefly touch upon this valuation issue, which is a very important one. And, you know, Chris hasn't seen any changes in the valuation in resilient sectors and the good opportunities. What about you, Emmanuel? Have you seen, you know, the valuations changing a lot? And, you know, how has that, is that been an issue for you?
I think the notion of valuation is not that much relevant to players like CVI. Like I said before, we rarely enter in transactions where shareholders are sponsors, right? So we are not in a situation where we need to agree on the valuation of a company. And as well, related to this, in the vast majority of the transactions we enter, we are in a position of a senior lender. So we are not in a position where we need to share the upside with shareholders. So we do not enter, you know, in the vast majority of cases, into discussions as to what is really the fair valuation of the company. But again, I think that in general, again, you know, CVI's market being SME companies in the region are by essence difficult to get valued, because we are basically here talking about small companies, and for smaller companies you always have a discount against, you know, generally admitted, you know, averages, you know, in the same industry, but which are for, you know, larger transactions. So I would say that the notion of valuation is not so important for us. What is really important for us is what can be realistically the performance of the company, which will allow debt service to be, you know, to be carried out, you know, as it's meant to be, and that's really what matters to us.
Lovely. Unfortunately, we are a little bit limited with the time, so we can just, you know, move towards the very concluding remark. And if I can ask both of you to provide me your outlook, however difficult that may be, for Q4 2020, Q1 2021. We obviously do not see the light at the end of the tunnel compared to the pandemic environment. How do you think will the private debt market, Emmanuel, for you, and mezzanine market evolve in this next 2 quarters? I don't dare to ask you beyond that because it's very uncertain.
I think it's easier to answer how long-term, you know, the trend will be, and I'm quite confident that private debt in the CE region will continue to grow, because it's a necessary tool to support growth of companies of any size in the region to complement bank financing.
Lovely. And Chris, what about mezzanine?
Well, first of all, I am a bit concerned about the global economic outlook, but that aside, I think our prospects are really very good, because we're not a mass market operator, we're a solutions provider. And this crisis, the changes we're going through, will throw up lots of problems that need solutions. And we happen to be very well placed to provide it. We have flexibility in our financing ability. We have money. We have the local team. We have short reporting lines. So actually, I see it very positively.
You know, that is a wonderful news. Both of you are extremely optimistic on the outlook and the future market developments for both private debt and mezzanine. And with that, a very optimistic note, I would like to end this panel, and I would like to thank my fellow panelists for being absolutely wonderful. I do apologize to the audience on the technical issues which may have, and I would like to invite everybody to use the networking opportunity to continue this discussion, as well as to connect to all of the speakers in the audience via LinkedIn. Thank you very much for your participation. Thank you.
Thank you for having us.
Thank you.
Bye.
Bye.